In this video, I will explain how to calculate the valuation multiples for a company. Here I have the average price we just estimated on the previous video, and the first ratio is price to earnings. So this is basically the relationship between the price the market is on average paying in each year divided by the earnings per share, and that data we have it right here on top. So I will select earnings per share from our 8th row. So the number is 11. This 11 means the market is paying 11 times the earnings per share. As the market, I will just copy and paste or just autofill to the right till our last data. As you notice, the number is increasing over time. This means the company is being valuated in terms of earnings at a greater pace. So the company is more valuable to the market on this 10-year span time. And then there's more to say on the price to earnings, but this video is not intended to explain the analysis of the multiples, but to the mechanics, right? On next videos, I will explain more on the analysis. Then there is the price to book, which is the relationship between the price the market is paying divided by the book value of each share. For that, we select the price divided by the value per share, which is right here at the beginning. Book value per share, which is the net equity divided by the number of outstanding shares. It's right here, this one. So it says 5 times. So the market is valuing the stock 5 times more than the accounting information does. That reflects a greater value of the company, greater expectation of growth in the future, a greater value of the company right after you just consider only the accounting value. So there is a greater value in the company that is not reflected on just the accounting information on the market mind. And you notice the number is increasing over time on average, especially for the last year, 7 times on the estimation, 5 times. This might vary from the data you find on daily current information because remember, we're using an average price for every year, and the data on here is we obtain from the accounting might be on the same. But this doesn't have to be precise or perfect. Evaluation it's not perfect. Then there is the sales per share, which is a division of all the revenue the company is making on each year divided by the number of outstanding shares. In order to estimate that, we can go to the beginning. We have revenue into the millions, 60 billion of revenue for the year 2008, and then divided by the number of shares, which is also into 9 billion shares approximately. Then it's six times, so the company is selling $6 over one share, and that number is increasing over time, that is reflecting a more efficient development of the company's performance into the income statement. See, $6, $9, and last $11. So it's a greater revenue in relation to the number of shares. That's the company is again more efficient to that line. And then there is the price to sales ratio, and we have the information here. We have the price, the average price, divided by the sales per share, which is right here. So it's just a division, and the number is 3, and over time it increases, right? There's more to say. The numbers should not be read just by only considering the number itself. Also the behavior of the price, which is increasing over time, almost 3 or 4 times over the last 10 years, and the increase in efficiency for the company. Right, then again there is a price to cash flow per share. For that we have the price, the average price, divided by the cash flow also per share. We have it at the beginning. Free cash flow per share. And this is 10 times. So the market was paying in 2008 10 times the cash flow per share. And that is over time increasing. Right? So the prices has been increasing more than the cash flow per share does. So the market is valuing, that reflects that the market is valuing the company greater than it actually does on the cash flow per share. And last, there is a dividend yield, and we have the data. We have the dividend per share right here, dividend, in the beginning, on row 9, and we have the average price. That's a percentage, so I select the data, just estimate it. I will at the first menu, I will click on a percentage format. I might want to use at least one decimal to notice changes. And the data stays relatively the same over time, right?